Hi everyone! In this video, I'll be discussing how C corporations are taxed, tax pitfalls of C corporations, how to incorporate your business, etc. So let's dive in. Small business corporations are classified for tax purposes as either C or S corporations. These two letters refer to subchapters of the tax code. By default, business corporations begin life as C corporations. After incorporating, the shareholders may choose S corporation status if they want the business owners to be taxed like a partnership instead of a corporation. If you want to choose S corporation status, be sure to ask your CPA about the built-in gains tax before changing your corporate status. Double taxation of a C corporation's profits will occur if it pays dividends. However, dividends are not deductible corporate expenses like wages. Dividends are distributed only after corporate income taxes are calculated, taxed once. Next, the dividends are taxed again to the shareholders who receive them. C corporations must file annual federal tax returns, IRS Form 1120, U.S. Corporation Income Tax Return. The due date is the 15th day of the third month after the close of the corporation's tax year. If the corporation uses a calendar year, its tax return is due every March 15th. A corporation can get a 6-month extension to file its tax return. For example, September 15th would be the extended due date for a calendar year reporting corporations. If any corporate tax is owed, it must be paid along with the extension form 7004 to avoid penalty and interest charges. Most states require their resident corporations and corporations that do business in their state to file state corporate tax forms each year. The rules and deadlines may differ from the federal corporation rules. Most states require that a minimum corporate franchise tax, typically $50 to $800, be paid each year to maintain the corporate status. Tax pitfalls of C corporations. A C corporation faces two other potential federal taxes that other business entities don't have to worry about. Accumulated earnings tax. An advantage of a C corporation over other business entity forms is its ability to accumulate earnings to fund growth. These earnings are taxed to the corporations, but often at lower rates than if they are distributed to the shareholders. If, however, a C corporation keeps too much profit, it incurs an accumulated earnings tax of 20%. This tax does not kick in until accumulated earnings exceeds $250,000. Personal holding company tax. There is a special penalty tax for C corporations that earns 60% or more of their income from investments, such as dividends and royalties. Don't worry about this if you're running an active business. The specter of double taxation arises if a dissolving C corporation distributes assets or money to the shareholders, or a sale of the business's assets may mean the corporation owes tax on gain from the sale and the shareholders owe tax again on the money received for their shares. If the corporation has ever claimed any tax benefits, such as depreciation, on its assets, the corporation's basis in these assets may be very low or even zero. Depreciation deduction previously taken are recaptured on dissolution and become taxable. The result may be unexpected taxable gain even when the corporation disposes of these assets for minimal amounts. Here is a tax planning idea. Consider switching to S corporation status on your way out. One way around any double taxation problems on liquidation may be for a dissolving C corporation to elect S corporation status before it liquidates. File IRS Form 966, Corporate Dissolution or Liquidation, when your corporation is terminated. Dividends received from other corporations. Another tax break reserved for C corporations is the dividends received deduction. This helps if your C corporation holds stock of another corporation. This rule states that a C corporation may receive dividends from stock it owns in another unrelated corporation 70% or more tax-free. In other words, while you as an individual are taxed on 100% of a $1,000 stock dividend, a C corporation is taxed on no more than $300. 3 ways to incorporating your business. Putting cash into a new corporation. Typically, people put money into a corporate bank account in return for shares of stock. This is called capitalizing the business. There are no tax consequences of acquiring stock. You are making an equity investment. The taxes come later if and when you get rid of your stock. Lending money to your new corporation. Incorporators are often tempted to lend money to their new corporation rather than purchase stock. However, there must be a cash or property investment or equity for stock. A shareholder cannot take back any corporate IOUs or debts for his or her initial contributions to a startup. Only when a corporation is up and running may a shareholder loan be okay. Putting assets into a new corporation. It's okay to transfer things other than cash, such as buildings, vehicle, or patent you own, to your corporation in exchange for its stock. It's worth paying attention to how you do the transfer so that you can take advantage of an important tax break that's available for these types of transfers. Section 351 transfers. Transferring an asset to a corporation for stock is potentially taxable. Thankfully, a special tax code provision, Section 351, lets you avoid paying any taxes at the time the transfer is made. With Section 351, there is no tax until you sell at a profit the stock received in exchange for the asset, or the corporation is dissolved and you receive money or assets worth more than your initial investment. How to meet Section 351 conditions. When transferring assets to your corporation, 4 conditions must be met to qualify as a Section 351 transfer. Number 1, the corporation must receive assets in exchange for stock. Real estate and equipment are the most common types of assets, but you can also transfer just about any type of property. Number 2, shareholders must receive only stock in exchange for the property. Transfers cannot take back cash, bonds, corporate promissory notes, or more complicated instruments like stock warrants or stock options. And each shareholder must receive stock in direct proportion to the fair market value of the property transferred. For instance, if a transferor gets anything but stock, its value is taxable income to that shareholder. So if in addition to stock, Jack receives a $10,000 promissory note from Jack and Jill Inc., $10,000 of income is taxable to him. Number 3, the shareholders who transfer assets must own 80% of the corporation. Taken as a group, shareholders who transfer property for stock must own at least 80% of the new corporation shares after the transfer. So for example, Alexa, Rosa, and Josh want to incorporate and use Section 351. Alexa and Rosa transfer $170,000 in biotech research equipment, previously used by their P&R partnership, in return for 75% of the shares of BioResearch Inc. Josh, who is retired and does not intend to work in the business, is internationally known in this field. The corporation gives him 25% of the shares outright on condition that he can advertise his name as a shareholder. This transaction fails Section 351 rules because after the transfer, Alexa and Rosa own less than 80% of the stock. Number 4, no stock may be given in exchange for future services. This condition of Section 351 causes the most problems. Any shareholders who get stocks for their promise of service will owe income tax on the value of the stock received. For example, Wanda and Perry from form Galaxy Inc. to help businesses advertise on the internet. Perry contributes $100,000. Wanda, who is broke, promises to apply her skill with online networks. They each receive 250 shares of Galaxy Inc. Wanda's stock doesn't qualify under Section 351, so she is taxed on $100,000, the value of her shares. Perry is not taxed because he is qualified under Section 351. Given this result, Wanda may not want to become a stockholder of Galaxy Inc. Valuing stock in Section 351 transfer. Stock received for assets other than cash has the same tax basis as the asset. In tax lingo, this is substituted basis. So the tax basis of your stock equals your basis in the property you exchanged for it, not the property's fair market value. For tax purposes, you have the same investment in the stock as you did in the asset transferred for it. If you have property that has gone down in value, you won't want to do a Section 351 transfer with that property. As a shareholder, you cannot claim a taxable loss when transferring property to your own corporation under Section 351. That means you lose the potential tax benefit of a tax loss for that property. In addition, the IRS related party rules prohibit shareholders with more than a 50% interest in a corporation from claiming any tax losses on transactions between the shareholder and the corporation. Transfers to a corporation may still be taxed under state and local laws. Section 351 is a federal tax rule. State and local laws may treat transfers of shareholder assets as taxable sales to the corporation. For example, a retail clothier transferring his inventory of men's suits to his new corporation may be hit with his state's sales or inventory tax. There may be other unexpected state tax issues from a Section 351 transfer. For instance, real estate transfer to a corporation may trigger a property tax reassessment. In California, it usually means a property tax hike. You might be better off leasing your real estate to your corporation. Leasing assets to your corporation. Real estate is the asset most commonly leased to a corporation by its shareholders, but leasing can also work for equipment or machinery. Leasing to your corporation can produce a paper loss for you, the shareholder, which you may be able to offset against your other income. Typically, the loss comes from your depreciation deduction on the leased asset. It can also come when cash expenses exceed cash income. Either way, the loss may offset or shelter any other income on your tax return. Example, on January 1st, L buys a building for $100,000. He immediately leases it to his C corporation, Triple Z, Inc., at the market rate of $12,000 per year. Since the building is worth $80,000, the lot is worth $20,000, L is allowed to take depreciation deduction of $2,051 per year. L incurs annual expenses for real estate taxes, maintenance, and mortgage interest on the building, totaling $11,400. After applying the rent payments from Triple Z Inc., L reports a loss of $1,451 on his tax return. That's $12,000 income minus $11,400 expenses minus $2,051 of depreciation equals $1,451 of tax loss. Note, passive loss rules for real estate may limit L's ability to offset rental losses against other income. Leasing assets limits your liability. A good non-tax reason for leasing personal assets to your corporation, rather than having the business own it, is to protect them from corporate liabilities. For instance, suppose your corporation is successfully sued for sexual harassment. The judgment can be collected against the corporation's property, but your leased assets are probably safe. Even if the corporation declares bankruptcy, leased property is not a corporate asset. It still belongs to you, its owner.